Most traders think success comes from finding more opportunities. They're wrong. Here's what actually separates consistently profitable traders from those who blow up their accounts within months. A landmark study tracked professional fund managers over 15 years and discovered something shocking. The traders who executed fewer than 25 trades per month outperformed those making over 100 trades by a staggering 73% in risk-adjusted returns. Let that sink in. They traded less and made significantly more money. This isn't motivational talk about slowing down. This is mathematical proof that patience creates quantifiable financial advantages in markets. Yet everything in modern trading culture pushes you toward the opposite behavior: flashing notifications, real-time price alerts, Telegram groups posting every tick, social media traders bragging about their latest scalp. The entire ecosystem profits from keeping you glued to your screen, finger on the trigger, ready to fire. But what if the real edge isn't spotting more setups? What if it's having the mental discipline to pass on most of what you see? Let me show you two completely different approaches to the same market. Marcus wakes up, opens his charts, and immediately starts hunting. He's scanning 12 timeframes across 8 currency pairs, looking for anything that might move. By 10 a.m., he's already in 3 positions. By lunch, he's taken 7 trades. By market close, he's executed 29 trades in a single day. He feels accomplished, engaged, productive. He's putting in the work. Meanwhile, Emma sits down with her morning coffee, reviews her watch list of 5 pairs, identifies 2 potential setups that match her criteria, and then she waits. She reads market structure. She analyzes where institutional orders might be sitting. She prepares her plan for different scenarios. Most days she takes 1 trade. Some days she takes 0. Over the course of a month, Marcus averages 147 trades. Emma averages 19 trades. On the surface, Marcus appears to be the dedicated professional. He's active, engaged, always in the market. Emma looks almost lazy by comparison. She spends most of her trading hours simply watching, analyzing, waiting. But here's what the numbers tell you after 6 months. Emma's account has grown 41%. Marcus's account is down 22%. Identical market conditions, same time period, radically different outcomes. The difference isn't skill level. It's not access to better information. It's not even about having a superior strategy. The difference is patience. Emma has learned something that Marcus refuses to accept. Markets reward precision, not activity. She's figured out how to separate productive action from pointless motion. Marcus confuses being busy with being profitable. This exact pattern shows up everywhere when you study professional trading operations. Elite hedge funds don't trade continuously. They wait for specific market conditions, specific structural setups, specific opportunities that align perfectly with their thesis. Then they execute with size and conviction. Look at Berkshire Hathaway, arguably the most successful investment operation in modern history. They've held certain positions for decades without touching them. Warren Buffett's famous quote about his ideal holding period being forever isn't just clever marketing. It's a fundamental philosophy about patience creating value, and this principle doesn't only apply to long-term investing. Even in active day trading and swing trading, patience generates compound advantages that most participants completely overlook. When you're patient, you naturally gravitate toward higher quality setups. You filter out the noise that destroys capital. You conserve mental energy for genuine opportunities instead of burning yourself out chasing random price movements. Think about the logic here. If you're executing 150 trades monthly, you're essentially claiming that markets present 150 legitimate high-probability opportunities every single month. That's more than 7 per trading day. Does that pass the common sense test? Are there really 7 genuinely profitable setups appearing every single day across all instruments and timeframes? Obviously not. What's really happening is that impatient traders lower their standards. They take marginal setups because they cannot tolerate the psychological discomfort of sitting still between real opportunities. They're trading to satisfy their need for action rather than trading their actual edge. They're medicating boredom with bad trades. Patient traders understand something crucial about market structure. Price action exists in clear trends only about 20% of the time. The remaining 80% is choppy consolidation, false breakouts, and random noise. Patient traders aren't trying to extract profit from every wiggle on the chart. They're waiting for the 20% where probability genuinely favors directional movement. This creates mathematical advantages that compound dramatically over time. Consider the math. Both Emma and Marcus risk 1% per trade. Emma takes 19 carefully filtered trades per month with a 67% win rate and 2.1 to 1 average risk-reward ratio. Marcus takes 147 trades monthly with a 38% win rate and 1.1 to 1 risk reward. Even though Marcus is taking nearly 8 times more trades, Emma's selective approach generates superior returns with massively less screen time and psychological stress. But the advantages extend far beyond just better trade selection. The psychological benefits of patience create cascading effects that determine whether you survive long-term or flame out spectacularly. When you're patient, you operate from a position of strength rather than desperation. You're not chasing price. You're not revenge trading after losses. You're not overtrading because you feel guilty about missing yesterday's move. Patient traders develop what I call conviction-based execution. They trust their methodology completely because they've invested the time to validate it properly. They've backtested their setups across multiple market regimes. They know their true win rates, their actual maximum drawdowns, their real psychological tolerance for variance. This deep-rooted confidence allows them to execute their approach consistently without second-guessing every decision or jumping strategies after 3 losses. Impatient traders exist in perpetual reactive mode. They make decisions driven by fear of missing out rather than actual edge. They hop between methodologies because they never commit to one approach long enough to properly evaluate its effectiveness. They're emotional rather than systematic, reactive rather than proactive. This emotional difference creates feedback loops that either build success or guarantee failure. Patient traders experience frequent wins because they're selective about entries. Frequent wins create positive psychological reinforcement. Positive psychology leads to better decision-making. Better decisions generate more wins. It's a virtuous cycle that builds unstoppable momentum. Impatient traders experience the inverse. Lower quality setups produce frequent losses. Frequent losses create negative psychological states. Negative psychology leads to worse decision-making. Worse decisions produce more losses. It's a vicious cycle that simultaneously destroys accounts and confidence. The neuroscience here is fascinating. When you experience repeated losses, your brain undergoes actual structural changes. The prefrontal cortex, responsible for rational analysis and planning, becomes less active. Meanwhile, your amygdala, the primitive fear center, becomes hyperactive. You're literally making yourself less intelligent and more fearful with every impulsive trade. Conversely, when you maintain patience and selectivity, your brain stays in optimal state for pattern recognition, probability assessment, and disciplined execution. You're operating from your highest cognitive capacity instead of your most primitive fear responses. But patience in trading isn't passive observation, it's active preparation. While impatient traders frantically click buttons, patient traders study market structure, analyze institutional order flow, monitor economic catalysts, and prepare detailed plans for multiple scenarios. They're loading their mental arsenal so they can fire with maximum precision when genuine opportunity arrives. This preparation creates another massive edge. When real opportunities do materialize, patient traders are ready. They've already completed their analysis. They know exactly what they're looking for and precisely how they'll respond when conditions align. They can act decisively because they've been preparing for this specific moment while everyone else was busy. Impatient traders, exhausted from constant activity, often miss the best opportunities because they're unprepared. They're so busy reacting to noise that they fail to recognize signal when it appears. They're depleted rather than primed. Market structure itself rewards this patient approach. Most significant tradable moves occur during specific windows when institutional capital flow creates genuine directional momentum. Outside these windows, price action becomes increasingly random and unpredictable. Patient traders recognize these temporal patterns and focus attention accordingly. Impatient traders treat all market hours as equal opportunities and then wonder why results are so inconsistent. Professional trading operations understand this completely. They don't evaluate traders based on how many positions they take. They evaluate based on risk-adjusted returns, consistency across time, and psychological stability under pressure. A trader executing 30 trades monthly with steady profits is infinitely more valuable than someone taking 300 trades with erratic, unpredictable results. The proprietary trading industry provides perfect validation of these principles. Prop firms manage billions in institutional capital and require consistent, predictable returns. They're not seeking gamblers who occasionally hit home runs. They want traders who can grind out reliable profits month after month without catastrophic drawdowns that blow up accounts. When prop firms evaluate candidates, they examine specific metrics: average holding time, trades per session, maximum drawdown periods, and consistency of returns. Notice what's absent from evaluation criteria. They don't care about your biggest winning day. They don't care about your most spectacular trade. They care exclusively about sustainability and process adherence. The challenge structures these firms use reveal everything about what actually works. Most prop challenges give specific profit targets with strict drawdown limits. You must achieve a certain return while never exceeding maximum loss thresholds. This environment naturally rewards patient, conservative trading over aggressive speculation. Think about the mathematics. If you need 8% profit while staying under 4% drawdown, every single trade becomes critically important. You cannot afford marginal setups because even a brief losing streak could terminate your challenge. You need high-probability trades with favorable risk-reward characteristics. This structure forces patience whether you want it or not. Traders who consistently pass these challenges share common characteristics. They take fewer trades, hold positions longer, and obsess over risk management. They've learned that capital preservation matters more than profit generation. Once you stop losing money on bad trades, making money on good trades becomes remarkably easier. But here's what most people miss about patience and trading. It's not just about waiting for better setups. It's about developing a fundamentally different relationship with markets themselves. Impatient traders view markets as something to conquer, to extract from, to beat into submission through force of will. Patient traders view markets as something to synchronize with, to flow alongside, to understand at a deeper level. This philosophical shift changes everything. When you're trying to beat markets, every price movement becomes a personal challenge. Every loss feels like defeat. Every missed opportunity feels like failure. You're constantly fighting against forces much larger and more powerful than yourself. When you learn to sync with markets, you stop taking things personally. Losses become data points rather than personal attacks. Missed opportunities become preserved capital rather than failures. You're working with natural market rhythms instead of battling against them. Professional traders describe this as reading market sentiment or feeling institutional flow. It sounds mystical, but it's actually quite practical. Markets have natural rhythms, expansion and contraction cycles, periods of high conviction and periods of uncertainty, institutional accumulation and distribution phases. Patient traders learn to recognize these cycles and adapt their approach to current conditions. During high-conviction periods when institutional money moves decisively, patient traders slightly increase activity because genuine opportunities appear more frequently. During uncertain periods when markets chop through ranges, they pull back almost entirely because few trades offer real edge. This adaptive patience differs completely from rigid rules about trade frequency. It's responsive to actual market conditions rather than arbitrary quotas. Some months you might take 35 trades because conditions are favorable. Other months you might take 8 because nothing meets your criteria. Both approaches can be absolutely correct depending on what markets are offering. The key insight is that patience allows you to be opportunistic rather than mechanical. You're not forcing a specific number of trades per week or maintaining consistent activity levels for the sake of consistency. You're taking what markets give you when they give it to you, and nothing more. This flexibility creates significant advantages over purely systematic approaches. Market makers and algorithmic trading systems operate on completely different principles. They're designed for high-frequency, ultra-low margin transactions across massive volume. They profit from tiny edge percentages because they're operating at enormous scale with essentially unlimited capital and infrastructure. Individual traders attempting to compete with this approach are playing the wrong game entirely. Your advantage as an individual is exactly opposite. You can be selective. You can wait indefinitely. You can choose only the most favorable conditions. You don't need to generate returns every minute of every session. You can afford to wait for genuine opportunities because you're not paying overhead on massive technological infrastructure. This selectivity compounds in ways most participants never consider. When you're patient, you naturally develop deeper market understanding. You spend more time observing and less time reacting. You start noticing patterns that only become visible when you're not constantly distracted by execution. You begin recognizing institutional accumulation and distribution signatures. You start sensing when momentum is genuine versus when it's artificial and likely to reverse. You develop intuition about when markets will continue versus when they'll mean revert. None of this learning happens when you're frantically jumping in and out of positions every few minutes. The educational value of patience is enormous and often overlooked. Every trade becomes a detailed case study rather than just a profit or loss event. You have time to analyze what worked, what didn't, and why. You can identify genuine edges versus random luck. You can refine your approach based on actual evidence rather than emotional reactions. Impatient traders never develop this deeper understanding because they're too busy taking the next trade to properly analyze the last one. They're stuck in perpetual cycles of action without reflection. They might accumulate years of screen time without actually learning anything meaningful from the experience. The compounding effect of this learning advantage cannot be overstated. Patient traders improve continuously over time because they're actively studying results and refining methodology. Impatient traders plateau quickly because they're not extracting lessons from experience. This creates divergence that widens dramatically over extended periods. After 1 year, the difference between patient and impatient traders might be modest. After 5 years, the gap becomes enormous. After 10 years, they're operating in completely different universes of skill and profitability. The most successful traders I've studied all demonstrate this characteristic. They've developed the ability to remain still when stillness is the optimal action. They've learned to distinguish between productive activity and busy work, masquerading as productivity. They understand that in trading, less is frequently more. But perhaps most importantly, they've discovered something that fundamentally transforms how you approach every decision. They've learned to measure success not by how much they made today, but by how well they executed their process. This subtle shift in success metrics completely transforms your relationship with daily market fluctuations. When your scorecard is process adherence rather than daily profit and loss, you become immune to the emotional roller coaster that destroys most traders. You can have a losing day while still feeling successful because you followed your rules flawlessly. You can have a winning day while feeling concerned because you deviated from your plan. This internal measurement system keeps you grounded in what actually matters long term. The psychological liberation this creates is profound. You stop obsessively checking account balance every few minutes. You stop celebrating small wins as if you've unlocked infinite wealth. You stop treating small losses as personal catastrophes. You develop emotional equilibrium that allows consistent decision-making regardless of recent results. This emotional stability becomes your ultimate weapon in an industry specifically designed to exploit emotional weakness. Every market movement, every breaking news headline, every social media post about someone's latest winner is engineered to trigger fear or greed responses. Patient traders have developed immunity to these triggers because they're focused on process execution rather than outcome optimization. Consider how this plays out during major market events. When breaking news hits and prices start moving violently, impatient traders immediately scan for ways to capitalize. They're looking for breakout opportunities, momentum plays, volatility trades. Their default instinct is always action first, analysis second. Patient traders respond completely differently. Their first instinct is assessment. What's driving this movement? Is this institutional flow or retail panic? Does this create genuine opportunity or just apparent opportunity? How does this align with existing analysis and positioning? They're asking questions while others are clicking buttons. This deliberate pause frequently reveals that what appears to be obvious opportunity is actually a trap. News-driven volatility creates false breakouts, stop hunts, and whipsaw movements that punish reactive traders. Patient traders avoid these traps by investing time to understand what's actually happening before committing capital. The market rewards this measured approach because institutional players operate identically. Large funds cannot move quickly even if they want to. They need extended time to accumulate or distribute significant positions without moving price against themselves. They're naturally patient because their size demands it. When you align your behavior with how institutions actually operate, you're swimming with the current instead of against it. The evidence is overwhelming and undeniable. Reducing trade frequency by half can increase returns by over 70%. The psychology confirms that patience preserves mental clarity while impatience literally rewires your brain for failure. Market structure rewards selective precision over constant activity. Institutional validation through prop firm success metrics proves that less is more. Your edge isn't finding more opportunities. Your edge is having the discipline to ignore most of them. The market will always present another opportunity tomorrow, next week, next month. But your capital and psychological stability are finite resources that must be protected ruthlessly. Start measuring success by how well you execute your process, not by how much you made today. Develop conviction through selective execution rather than hoping volume will eventually produce results. Remember that patience isn't passive waiting. It's active preparation, continuous learning, and disciplined execution. Master patience, and you've mastered the ultimate trading edge that 95% of participants will never develop. While everyone else frantically chases every tick, you'll be calmly waiting for the setups that actually matter. And that patience will transform your results in ways that no indicator, strategy, or secret system ever could.